Good evening, everyone. Welcome to our University of Florida Alumni Homebuyer Workshop. My name is Jason Maida. I'm with American Pacific Mortgage. Great to have you this evening to join our class. We appreciate you taking time out of your busy schedules to join us on your Thursday night to learn a little bit more about home buying. This is a very interactive session that we do 4 times a year for the University of Florida Alumni Association. I know we have a lot of signups for tonight's class, so we're going to allow everybody to get into the Zoom session and then we'll get started. This is a very interactive session. So as we go through tonight's presentation, which has a runtime of about an hour, so within that hour, we'll weave in questions and, of course, answers from our audience. So we'd encourage you to use either the chat function within Zoom or the Q&A function. We'll get those questions answered on air. We'll also carve out a little bit of time at the end of class to answer any kind of remaining questions. And we're also recording tonight's class. So if you have to step away or whatever, or just kind of want to check back in later in tonight's class, we'll have this class recorded. It'll also be up on our YouTube channel. We had a lot of signups for tonight's class, so we're going to email out all the presentation material as well as the link to our YouTube channel to be able to kind of listen back to tonight's class. Well, we're glad you got a chance to spend this Thursday night with us. This is our second installment of classes that we've taught for the association. Really excited to be able to bring this content to you. We get a chance to teach classes like this all across the country. The University of Florida Association is one of our newer partnerships, but it's been a really successful partnerships. I've got a chance to have a lot of great conversations with fellow alumni to help kind of lead them in home buying. So wherever you're at in your journey towards home ownership, we hope that this class will be helpful for you as you begin that path towards home ownership. A little bit about our organization. So I work with a company called APM, which is American Pacific Mortgage. We're a nationwide lender. So we're one of the top 10 lenders in the country. Our team here is one of the top 100 originating teams in the country. And what we do is we specialize in educating our local communities on home ownership. So as you attend a class like this, we want to stay connected with you. So as the time comes that you consider home ownership, we'd love to be able to partner with you along that journey. So we are a mortgage company essentially is equipped to support you with the resources needed to purchase your home. All right, well, tonight's class is, like I said, a very interactive class. We have some content built out with some talking points that you can see here on screen. So we're going to talk a little bit about just the housing market and kind of what's going on in the Florida market specifically. I would be curious to know kind of where some of us are joining in tonight's class, so where you're at in the country. So, if you do have a minute, if you want to pop in the chat kind of where you're thinking about buying or where you're joining us from, maybe we can comment a little bit about other housing markets across the country. But we'll spend some time looking at the housing market. We'll also spend some time looking at interest rates and what's going on kind of in the economy that's really influencing interest rates. And then we're going to launch in just a few minutes into a buy versus renting exercise, which essentially we're looking at what does it look like to continue renting right now versus if I consider home ownership, what's that number going to look like for me? So we'll do that in just a few minutes. We'll also spend some time looking at credit. How do we kind of manage our credit, maybe managing down debt, and maybe some tips and resources on lifting my credit score. We'll also talk about underwriting guidelines for various loan programs and resources that are available to you as buyers. And then as we kind of think about home ownership, savings can be a big challenge for us. And so we're going to kind of go through some ideas around saving for home ownership. And then we'll look at first-time home buyer programs that are offered in the state of Florida, as well as nationwide programs that are available to you. So we'll spend some time looking at that. And then as we kind of get towards the latter stages of tonight's discussion, I want to walk you through the home buying process. So after you kind of attend tonight's class, what comes next from here? Whether you're on the path to home ownership this year in 2025, or it's something that's maybe a goal further out for you, maybe 2 or 3 years, we want to kind of help educate you on what that looks like and the different milestones as you proceed towards home ownership. All right. For those of you that got a chance to put your location or kind of ideal location for purchasing in the chat, thank you for doing that. So I think most of our audience is either in the Florida, North Carolina market, which certainly markets we service. So really excited to kind of probably maybe share more of kind of specifically those communities with you in tonight's session. Well, when we think a little bit about home buying, this is probably going to be one of the biggest financial decisions you make, right? So not ideal for you to attend a class on a Thursday night. Probably have other things that you'd rather do, but obviously you understand the importance of making a really sound financial decision because it's going to be probably one of the biggest ones you make. When we consider home ownership, I would encourage you to think a little bit about the benefits that come along with owning a home. For one, it creates hopefully more affordability for you in owning a home because ultimately you kind of control your budget when it comes to owning a home. You don't have to worry about a landlord that's increasing the rent as you renew your lease. So that's a really huge benefit of a home ownership. Also, those that are choosing to buy in today's market, you may be buying at slightly higher elevated interest rate levels. However, though, 2 years from now, or maybe a year from now, we'll start to see rates start to normalize as our economy and some certainty kind of comes back into play. We'll start to see interest rates drift lower, and that does present the opportunity of refinancing a home, which essentially is taking your existing balance and refinancing it at a lower market rate as opposed to what you bought the home at. And then this is an asset. Like I said, it's going to be the biggest financial decision, but it's also probably your number one asset that you have. And this has an opportunity to grow in equity over time. So as my home appreciates over time, as I pay down my balance, the difference in those two numbers creates home equity. And for most of us across the country, again, is the number one asset that we have. And the third opportunity with home buying is potential tax benefits that can exist with home buying, the potential tax deductibility of interest, potential tax benefits of energy efficient upgrades. And in some states across the country, there's mortgage credit certificates available, which is called an MCC, where for certain first time buyer programs, you can get up to 15, at some cases, 20% in tax credits of the interest that you pay on a mortgage. So a lot of great benefits that come along with owning a home. So I would encourage you to kind of think more about that as you're comparing your budget of renting for the next few years versus what it could look like with ownership. Now, to help you kind of think through that a little bit more, we want to walk you through a rent versus buying calculator. And I know we've had some of you join a little bit late, so I do want to share with you that we are recording tonight's class. But we're also going to send out all the presentation material tomorrow morning. So one of the things with this presentation material includes the link to this calculator that I'm going to walk you through right now, which is our rent versus buying calculator, taking a snapshot of what it looks like to rent versus ultimately what it could look like to own. So for time purposes in tonight's discussion, we went ahead and kind of pre-filled this in for us. But I would encourage our class that if you have some time in the next few days after you get the presentation material, try to dive into this calculator and check it out for yourself and see what your own personal scenario looks like. So for the situation that we have up on screen here, we have someone that assumes a rent payment of like $2,000 a month in rent. We have $15, as you can see here, for the renter's insurance. And then we have an assumption that the rent will increase 3% on an annual basis. So that's ultimately kind of what the rental side of our equation looks like. And then if we drop down into this other tab here, we have a home purchase, an assumption of $425,000. We have an assumption of a 3% minimum down payment. We're going to talk more about minimum down payments when we get to our product sections of tonight's class. But ultimately, on a conventional 30-year fixed mortgage, as a first-time buyer, the minimum down payment is 3%. Then we have property taxes that we put into our equation. We have homeowners insurance costs. Of course, those homeowners insurance premiums can change based upon where I'm going to purchase in the state. And so we kind of baked into our calculation $2,500. That varies. We have maintenance costs on my home. So essentially the upkeep, how much cash am I going to have to allocate towards improvements to my house? And then we have loan information. So we assume a 30-year fixed mortgage. We put kind of an average interest rate, which is kind of subject to change at 6.6. And then we have origination charges in the financing side of things. Now, one of the things we're going to point out to you later in tonight's class, but as part of our partnership with our UF Alumni Association, we're going to discount our origination charges to make things more affordable for you. So we actually take our origination charges down by $750 to make things, like I said, more affordable for you. But ultimately, what origination charges are is what a lender charges you for your financing. All right, and then we have discount points here, which is our next line item. Discount points are where you as a prospective buyer can pay additional funds out of pocket to essentially bring down your interest rate. Now, usually a point is the equivalent of 1% of your loan amount, and usually that 1 point will bring down your interest rate about 0.25%. Now, the return on investment in those type of costs, if you will, usually is about 3 to 4 years. And quite honestly, in today's market, we don't generally recommend paying points unless we're trying to achieve a certain level of payment, because with a break-even point of 3 to 4 years, most clients buying, especially in 2025, are going to probably consider refinancing in 1 to 2 years. So there really isn't a great return on investment to consider investing in points at this point. Again, everybody's situation is a little bit different, but that would be kind of our general guidance there. And then we have other settlement services involved in your transaction, which is all encompassed around closing costs. And closing costs are anywhere between generally 2 to 3% of your purchase price. So when we think about savings for homeownership, I would encourage you to think a little bit about the down payment, which you're seeing right now is about 3% of your purchase price, plus those closing costs. All right. So that's the next point of our calculation. Now, the last assumption we're going to make is how much is our home going to appreciate? So that changes based upon where we're buying in the country, but we'll say 4% for now. We're going to look at being in our next home that we're going to purchase for 7 years. So we're going to say, what does it look like if I'm going to rent for 7 years versus what's going to look like if I own for the next 7 years? We have the selling costs of our home. We have state and federal tax rates, and then we have a savings rate. So ultimately, what our calculator tells us is a few things. One is, if I compare my side-by-side monthly expense, renting, I know I'm at $2,000 a month, but owning, I'm going to increase that substantially. That goes to $3,700 a month. So pretty big uptake in monthly outgo. But where we got to take into consideration ownership is the benefits that come along with owning a home, like home equity appreciation, potential tax deductibility, potential tax credits on first-time buyer programs. I have an opportunity to essentially grow in wealth $43,000 over 7 years versus continuing to rent for the next 7 years. I think that's where the area of opportunity comes for most of our buyers. And that doesn't include any improved cash flow when maybe we consider refinancing in a couple of years when rates start to normalize. So, as we consider home ownership and thinking about what your timeline looks like for your path to home ownership, I think using a calculator like this is a great way to have kind of as a launch point for yourself. All right. Again, we're going to send all that presentation material out to you tomorrow. So I would encourage you guys to do your own calculation when you have a free moment. All right. Let's talk now a little bit about the housing market. Now we're going to specifically look at the Florida housing market. What's interesting is the Florida housing market is one of 4 markets that has increased inventory and improved inventory, if you will, year over year, but it has one of the highest levels of inventory. Florida, Georgia, Texas, and Colorado all have one of the highest levels of inventory across the country. So as potential buyers, there really is an opportunity out there in the market. What we also found as an interesting stat is 44% of all transactions being done across the country have some type of seller concession involved in them. What that means is a seller has said, hey, I'm going to make concessions and credit you back a portion of my proceeds to reduce down or maybe reduce your out-of-pocket expense for the home purchase. Again, another great encouraging sign for first-time buyers. So if inventory stays strong and sellers are willing to make concessions, that does gleam some hope for some first-time buyers in the market, especially in the Florida housing market. So let's take a quick look at this. So we have our median price, which is, you can see, pretty flat right now. When we look at, the last 12, 16 months, somewhere around there, you can see kind of number of homes in the market. As we kind of push further out, the influence of interest rates and how that kind of affects these inventory levels. Obviously, as interest rates go lower, buyer demand kicks up. Clearly in the Florida market, we have the supply to support buyers. I think the real question is going to be are we going to start seeing more price cuts in the Florida housing market just because of standing inventory? We see a number like this, median days on market, 75 days, which is a significant number, leads me to believe that we'll probably see more extreme price cuts in the Florida housing market. And, to my point earlier, nationwide, we're already seeing seller concessions. So I think there is some really great opportunity for home buyers, especially in the Florida housing market. And, interest rates are going to play a role in, the influence of buyer demand, right? Now, in today's economic markets, if you're kind of watching what's going on, obviously there's a little bit of uncertainty in the markets, which creates a very volatile interest rate market. But I do think some of that uncertainty that we see in the economic markets can create some opportunities for buyers in the housing market. Now, if we look at the last interest rates over the last 12 months, you can see this kind of roller coaster ride that we're on right now. Just about 3 weeks ago, we hit the lowest levels we've seen in 2025, rates dropping to as low as 6.3%. That was a huge day for us. We're super excited. For the average consumer, they probably think, wow, that's still really high, right? but it was a win in interest rates. But that was shortly met by some adversity with, kind of the tariffs and what's going on globally with that. And so we saw interest rates kind of shoot back up. Now we're starting to see rates kind of settle back down. Today we're right around 6.75 in interest rates. But I think as we continue to have that uncertainty in the markets, we're going to see kind of this choppy market, if you will, from an interest rate perspective. Now, why we're at elevated interest rate levels, I think is important to understand, and probably for most of us do get it, because ultimately, as a U.S. economy, we're at high inflation levels, right? The mandate by the Federal Reserve is to get the inflation down to 2%. We're still running fairly hot at 2.5 or higher, depending on what report you receive. But ultimately, the Federal Reserve has increased the federal funds rate in order to combat inflation. As inflation gets under control and we show a strong labor market, we'll see that federal funds rate hopefully come down, and that will have ultimately a ripple effect into mortgage interest rates. But I think over the course of 2025, we're still kind of probably going to remain at some fairly higher levels, the mid 6 to high 6 levels. But I hope I'm wrong. I hope we see rates go even lower, but that's at least where we're at today. But if we look back 20 years ago, interest rates were about the same, which is quite interesting. Now, home prices looked a lot different, right? They're, significantly cheaper than where they are today. But, we're not too far removed from the same level of interest rates. Now, if we look at that course of 20 years leading up to today, this kind of graph you can see on screen, this bigger gray bar shows you the housing crisis of 2008, 2009. The interest rates drift lower out of that crisis. You can see we kind of stayed in this like 4-ish% range. This gray bar here represents the pandemic of 21, 22, where we saw interest rate levels get to as low as 2.5%. I bring this to your attention because I do get a lot of questions from clients that are waiting for the return of 2.5% and 3% interest rates. The reality is we're probably never going to go back there, and hopefully we never do, because ultimately we've had another catastrophic event in our country, or globally, I should say. So, I think when we look at historical average of interest rates, probably in the 5% range is more of a historical average. Ultimately, interest rates will cycle. And so as a buyer, obviously we want the perfect storm, lowest purchase price, lowest interest rates. Generally, you're not going to get a combination of the two, but, I think it's important to ultimately kind of understand, where the market is at right now from an interest rate perspective, because that will ultimately influence buying power. Now, interest rates look a little bit different for each buyer because there's various characteristics that go into interest rates. Now, the market conditions play a big role. So interest rates change by the minute. So as trading opens up on Wall Street, interest rates can fluctuate throughout the day. We may start the day at 6.75 rates, and we may end the day at 6.6 rates. It just depends on what's happening in our markets. And so, as I mentioned earlier, we have very choppy markets and interest rates. Now, the baseline interest rate has various characteristics like credit score, the eligibility to a loan program, the type of loan program that I'm going to do, how much I decide to finance, what my down payment looks like. And we talked earlier about discount points where I can ultimately pay some additional out-of-pocket expenses in order to bring down my interest rate. So that is certainly an option for buyers. Again, I don't necessarily recommend that in today's market. And then the shorter my term is for my loan, that can generally bring down my interest rate. Now, the standard program is usually a 30-year fixed mortgage, so meaning the principal and interest payments are spread out over 30 years. But if I decide to shrink that down to 20 or maybe even a 15-year term, that can bring down my interest rate. Ultimately, what we're going to do as part of our consultative process, we're going to sit down and meet with you on video just to figure out what the right home buying plan design is for you. And so our fellow alum with University of Florida, we got a chance to meet with from our last classes. We'd encourage you to do the same with us. We'll kind of help build a plan for you and figure out which product is ultimately the best match for you. Now, as we build home buying plans for clients, we take a deeper dive into credit. And so in our classes, we love to kind of talk a little bit about credit, give you some tips and resources on what credit looks like. As I think about homeownership for most of our clients across the country, there can be two challenges to homeownership. One can be around savings for homeownership because maybe I'm new in my career. I just don't have a lot of resources at this point. But it can also be credit because maybe I have higher obligations. Maybe I have a little higher credit card debt or maybe student loans. So we want to kind of figure out opportunities in the credit space. And so we'll do that right now. And as we look at credit, there are minimum credit score requirements by product. We put those kind of up on screen here so you can see some of these products that have those minimum credit score requirements. Generally, the lowest credit score to get financing is going to be a 580 credit score. Now, the lowest credit score that you can have is 350. You can go as high as 850. And so that's kind of the spectrum of credit scores. Now, there are various credit score factors that make up the score, and we're going to go through a credit kind of modeling, if you will, to show you kind of the different weightings that go within a credit score. But bigger events that you've had, larger events like maybe collections or charge-offs or bankruptcies, those things obviously will have larger impacts to your credit scores. But ultimately, anything from as little as an inquiry to a credit late, those usually have an impact from the date of the event within the most recent 12 to 24 months. Now, we're going to talk a little bit about credit utilization in a little bit, because that's one of the kind of the low-hanging fruit items for most clients, where we're kind of looking at managing down credit card debt. So we'll talk about that in just a second. Account closure, we're looking specifically at the length of credit I've had, and we really want to avoid closing out accounts that are revolving accounts, especially if they're more mature accounts that I've had for several years. We want to really avoid closing out those accounts. Now, in lending, we look at all three credit agency scores. Now, there's three agencies, which I know you're all familiar with: Equifax, Experian, and TransUnion. Each one of them report a separate score. There's also three different models to scoring. There's a credit card model, there's an auto financing model, and then there's a mortgage model. Of course, in financing for housing, we're going to look at the mortgage model, right? Now, we always take the middle score of all three scores. So if I'm at a 760 is my highest score, 740 is my lowest, and 740 is my middle, 720 is my lowest. We're going to take 740 when we evaluate qualifying for a product, an interest rate, maybe the cost of mortgage insurance. Now, if I'm going to apply with a co-borrower, whether that's my partner or somebody's going to co-sign, whatever the situation is, if that person's at 700, 680, and 660, we go off the lowest credit score, lowest middle credit score between both borrowers. So in that scenario, 680 would be the lowest middle score between both borrowers. So just something kind of to think through. Ultimately, as we build home buying plans for our clients, we're going to strategically look at your qualifying and figure out the right way to ultimately kind of build your financing options. Now, if you've had some past challenges on your credit file, this is a matrix that you can reference to see how long it's going to retain on your credit report. Now, again, to my point just a few minutes ago, it's going to have an impact within the most recent 12 to 24 months from the date of the credit event. Now, this is a look at the score calculation for the FICO mortgage score, credit score. And so I'm going to walk you through kind of each area here. You can see 15% is going to be how long have I had credit. So again, we really want to avoid closing out accounts, especially in the revolving space, because that is going to now wipe away all the credit history that you've had on a particular account. So if you're really trying to build credit, we want to try to build up that length of credit. The longer my credit profile is, or longer, more in-depth my credit profile is, probably the higher my credit score is going to be. Now, if you're new to credit and you're trying to just get started, in order to have a credit score appear, you have to have at least 6 months of credit history. All right, so that is 15% of the weighting. 20% is going to be how much new credit am I trying to open up? So am I trying to open up new accounts? Am I having new inquiries done on my credit report? That's going to be 20% of the weighting. Now, there is a difference between a hard inquiry and a soft inquiry. A hard inquiry is where a lender has taken a look at your credit report and accessed your credit file, and it can negatively impact your credit score. However, in mortgage inquiries and auto financing inquiries, you do have a 30-day window of time to shop around with as many lenders as you want, and it's the equivalent of one credit inquiry hit to your score. So that's how that kind of process works. Now, one of the things that we do a little bit differently than most lenders is we only start with a soft credit check inquiry when it comes to your pre-approval process. The reason why we choose to do that is because our timeline, especially for first-time buyers, it varies, right? Some clients are ready to go out and buy a house this weekend. Some are on a 2-year or 3-year plan. I met with one of our fellow alum just last month. They're looking to buy in October, right? But they came to a class a couple months ago. And so in that case, we don't want to do a hard inquiry because that would impact their score. Soft inquiry allows us to build a plan for them, set some goals and objectives for homeownership, but not impact the credit score. So that's 20% of the weighting there. The other component is credit utilization. How much do I owe in revolving credit card debt or revolving debt in general? Really simply, a look at this would be to look at the point of, if I have $5,000 in credit card balances and I have, let's say, $10,000 in credit limits, I'm currently at 50% utilization. Now, if I've charged a little bit more since then on my credit cards, and let's say my balances are $8,000, now I'm at 80% utilization of credit. Now, our step one, if we're currently at 80% utilization, is try to whittle those balances down to at least 50% utilization. We'll get a little more uptick in our credit score. Next step I would recommend a client to do is get to 30% utilization, another uptick in credit score. And then the optimal level would be at least to get to 10% or less in credit utilization. Now, one way of managing credit card debt, I'll give you as one of our tips for tonight, is to take a look at your billing cycle date on your credit cards. If you can get in the habit of paying down the balances or paying them off before your billing cycle date, you're going to do a couple things. One is you're going to get ahead of the credit card issuer sending out the data to the 3 agencies because they report on the billing cycle date. And when you do that, now you've brought your balance down. And so you're basically showing a lower utilization rate, which in turn helps bring up your credit score. So if you can get in the habit of paying down before the billing cycle date, you're going to get a much more improved credit score. Now, the last component is payment history. Essentially, how am I paying on my debts? Late payments are rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. So the more severe that delinquency is, the bigger impact I'm going to have on my credit score. Of course, again, we're looking at the most recent 12 to 24 months. If I had a late payment on a student loan back in October of 23, then, as I get further and further away from that late payment, the more kind of organic improvement I'm going to see in my credit score. Now, part of credit includes student loans, right? And so those of you that do have federal student loans, they're probably in forbearance right now because of the pending litigation on forgiveness of student loan debt. That creates a little bit of issue in financing right now because if I was to look at a credit report, probably doesn't have a payment appearing. Now, that litigation is supposed to be settled in September, October. Fingers crossed. We're really hoping that happens because it does change home buying plans for some clients because ultimately we have to count a minimum payment when it comes to qualifying with these student loans. So if you're in an active, let's say, SAVE plan as an income-based repayment program, and let's say you have $75,000 in student loan debt, we can count that $250 payment as long as you're actively repaying that at that level right now. But let's say you're in forbearance right now and you're not making payments. By default, if you're going to use a conventional product like a Fannie Mae home loan product, we have to count 1% of the balances, which would essentially be a $750 payment. Or if we're doing an FHA loan, which we're going to talk more about in our product section in just a second, we would have to use $375 as the minimum payment. So that can change qualifying, obviously, for clients. And so we're going to help navigate those student loan waters with you. But I just like to bring it to the attention of our classes because, it is kind of a different space that we're in right now because of that pending litigation. And hopefully we'll get some resolution to that later this year. But ultimately, kind of the takeaway, hopefully, for you on this section is if you're in forbearance, we got to kind of do a check on the calculation for the payment we're going to use. And if I'm in deferment, just because I'm back in school electively, then that would also have the same logic apply, which we would have to use a 1% balance or on a conventional loan or 0.5% for an FHA loan. All right. Before we get into our next section, I just want to kind of because we've had some others that have, I know we're in different time zones for our class. So any questions so far on any of the materials so far that we've covered? We can kind of do a deeper dive. If you do have questions, feel free to use the chat or the Q&A function in Zoom. I have both windows open right now, so myself or my partner Ken can field your questions as we go through this. But I want to make sure if we need to provide any clarity on any of those topics so far. All right, let's talk a little bit about products available to you as prospective buyers. And you can find a lot of this stuff online, but I think it's important to understand what the right application for you is with certain products. Now, we've spotlighted a few of them that we could find hopefully useful for you. And so let's kind of take a quick look here. The first product is a conventional loan product that would fall under Fannie Mae, Freddie Mac. Conventional in the lending space is about 60 to 70% of all originations across the country, minimum down payment of 3% and a minimum credit score of 620. Now you'll notice the maximum loan amount is at 806,500. We call that the conforming loan limit. That's the same limit nationwide. However, if you're purchasing in a high cost of living area, so I think most of us are going to be in markets that would be at the conforming loan limit. But let's say we're in New York or we're in Chicago or California, There are some cities that will be considered high cost of living markets where Fannie Mae and Freddie Mac will go up to 1.2 million in finance. However, the down payment minimum of 3% that you see here would elevate to 5% anytime we go over that maximum 806,500 number. Now, ultimately, that maximum loan amount gets updated every year based upon cost of living adjustments. We'll usually have that number by October or November of every year. The next loan is an FHA loan. FHA stands for the Federal Housing Administration. That is a government-backed loan. Has a minimum down payment of 3.5%, minimum credit score of 580 with a maximum loan amount of 524,225. Now, I will say that maximum loan amount is a little bit different by county. So depending on what county you're looking at, and if you're going to use FHA, it does have a maximum loan amount that will vary based upon statistical data for that particular county. Now, there has been some recent changes with FHA and the USDA product, which we're going to learn about in just a bit. With some of the changes in administration, they're on the FHA or government insured products, they're not allowed for non-permanent residents. So you do have to be a permanent resident to have access to a government insured program. There is no changes to the conventional loan program. So whether I'm a non-permanent resident or a permanent resident, no changes in those guidelines, but there has been changes effective next month for both the FHA and the USDA product. Now, the next product is a jumbo loan, which essentially is for clients that need a little bit more buying power that stretches beyond the limits of, say, a conventional product. Does come with it higher down payment requirements, usually 10 to 15% down, higher credit score requirements as well. Not typical for most of our first-time buyers that attend classes like this, but it certainly is available to you as well. One of the products we don't have on screen that just came to mind that I want to point out to you is we do have a physician's loan program that's also available to our clients, which ultimately provides a little more flexibility for clients that are in residency or just getting out of residency, maybe starting, with a new practice, whether that's, dentists, whether that's a physician, whether it's veterinarians, you can get eligibility for that program. Ultimately, the physician loan allows a little more of a relaxed approach when it comes to things like student loans and ultimately affordability of expenses versus income. So, if you're interested in a product like that might be applicable for you, we can certainly kind of talk offline about that. The VA home loan is a product designed to help support our veterans in their entry to home ownership. It does have a 0 down payment option, credit score minimum of 620. The VA loan really doesn't have a maximum loan amount. In fact, you can actually go up to $5 million with 0 down on a VA loan. So, obviously gives a lot of buying power for a veteran. For veterans that have any partial disability, they are exempt from what we call the VA funding fee, which normally for first-time buyers that are putting no money down is 2.15% of the loan amount, and then that gets kind of added into the amount financed. And the last product I want to spotlight here is the USDA home loan. That's for clients that are looking to buy in more rural areas. USDA stands for the United States Department of Agriculture. So as you kind of expected, it's a 0 down payment option. So that's one of the big draws to that product. Minimum credit score of 620, very similar to the FHA product in terms of guidelines. And the maximum loan amount will vary based upon location. With USDA, the two big qualifiers are location. So it has to be deemed as a rural area in the USDA website. And there's income limits based upon the household size. All right. Okay, and there's a question that came in the chat, which is, are there programs for students starting a PhD program or en route or on a route that can help PhD students get a first-time homebuyer with a limited stipend given by the university? So in that question, you can possibly do more traditional programs. You might have to do like, a physician's loan or something like that. Depending on the length of the stipend you're receiving from the university, most stipends will have to verify that they're going to have continuance for 3 years. But we can talk a little bit about your scenario. In the past for my other, university partnerships, we have used university stipends to help qualify clients. In some cases, that can be recognized through more of your kind of traditional products like we've just kind of gone through. All right, thanks for that question. I want to take a deeper dive into 2 products around mortgage insurance. And there's a lot of kind of misconceptions around mortgage insurance. PMI or private mortgage insurance, and then there's also MIP, which is mortgage insurance premium. Essentially what those things do is they ultimately provide insurance to the lender against default by the buyer. So if someone was going through an economic challenge, the mortgage insurance company would step in and provide financial support for the lender against the default. Now, you as a buyer pay mortgage insurance costs, and so I want to kind of spend some time looking at the different characteristics and premiums involved with mortgage insurance. So on the first side, we have PMI, which is private mortgage insurance. There's ultimately 7 or 8 companies that provide that private mortgage insurance, and they set their premiums based upon a few parameters. They look at down payment, credit score, and then how much you finance. So that'll make up the premium of mortgage insurance. Now, on a conventional PMI product, you have a cancellation option that when you at least achieve 2 years in your loan and you have 22 to 22% equity, you can apply to have the mortgage insurance canceled. Now, that's one of the big benefits of a conventional loan. Now, if you started your home search on Redfin or Zillow already, that's great. If you've chose to use some of the calculations on those sites, the PMI calculations don't appear to be very accurate because they're not calibrated to some of the premium criteria that I shared with you. If we looked at a loan amount of say 450 and we had credit scores of 740 and we were putting down 3%, the mortgage insurance is about $138 a month. So it can be affordable, especially for clients that are higher credit score customers. Now, the higher your credit score goes, the more you put down, the lesser that premium is going to be. Now, FHA looks a little bit different because there's 2 forms of mortgage insurance. There's actually monthly mortgage insurance, which is 0.55% of my loan amount. Then I also have upfront mortgage insurance, which is 1.75% of my loan amount. That 1.75 gets added into my total loan amount. And then the 0.55% is now divided by 12, and that's what I pay as a dollar amount on a premium basis. Now, with FHA, there is no cancellation option. The only way really we're going to transfer out of FHA is through refinancing. So when I think about the FHA product, it's going to be more of an opportunity as an entry point to homeownership for a lot of our buyers. So we can utilize FHA to gain access to homeownership. And then as things change, maybe our credit improves, maybe our income improves, our equity position changes in our house, we would want to ideally transfer into a refinance from FHA to a conventional product. Now, with FHA, it is going to provide a lot more flexibility and guidelines that we'll see from a conventional perspective. When we think about expenses versus income, or we're looking at maybe some past credit challenges, FHA will give us a little bit better flexibility there. So let's look at the premium here. That you can see, you have a same loan amount of $450. We have an upfront mortgage insurance premium of $78.75. So that gets added into the total amount financed. And then we have the monthly mortgage insurance of $206 per month. So that clearly has a different expense size than you see with the conventional loan. But again, FHA is going to give a little bit more flexibility for some of our clients in their qualifying. So as we get a chance to kind of tailor and customize some options for you in home ownership, we're going to figure out obviously what the best product match is for you, but that hopefully gives you a little bit of an idea of what mortgage insurance might look like for you. Now, as we build plans for clients and consider eligibility for certain programs, we take a look at income. Beyond credit and assets and the product type, we've got to take a look at income. So there is ways that we validate income, and you can see some of the documentation on screen that we generally ask for. So if you're a W-2 employee, we usually ask for the last couple of years of W-2s, recent pay stubs. So we'll verify that way. And then if you're self-employed, we have to see the last couple of years of tax returns. And there's some calculations that we go through. Now, in lending, we generally have to verify that you have at least 2 years of work or educational history. So if I just graduated from UF in the fall and I just started my job January 1, that's okay. I can still show that I had educational background of 4 years, for example, and now I just started my job. That can meet the 2-year requirement. Even in some scenarios where I've been on my job for a year and I can show a 2-year work history over time, if I'm getting ready to start a new job, we can still potentially use that new employment history to help you qualify for your home financing. So where it gets a little bit more challenging from a 2-year perspective is if I have dual employment. So let's say I work in 2 different locations and I'm in the medical field. I work for 2 different organizations, I should say. In that scenario, I do have to show that I've been working on both sites for 2 years simultaneously if I want to use both sources of income. Otherwise, if I just have one employer, then as long as we can verify 2 years of education or employment history, then we're all set. So we have a lot of clients that will reach out to us that are getting ready to switch jobs, for example, and they have an offer letter but haven't quite made the move yet. Maybe it's because of a relocation or just a new job opportunity in their local market. We can still potentially use the offer letter to help someone qualify for their home financing. Now, I want to touch on a couple more things in income, and then we're going to talk a little bit about expenses versus income. But one of the other questions that comes up is looking at other sources of income that a household may have. So for example, if I'm qualifying with just my income, but I know my partner contributes to the income, in order to use my partner's income, they would have to be a part of the application. So we can't add additional income sources unless they're validated and that person is part of the application. Also, if I have a situation where, let's say I rent out a room in my current place, for most products, we won't be able to be inclusive of that room rental because it probably won't carry over to the next property. And last thing I want to touch on is a lot of our clients will be working a 40-hour work week, but maybe they have some extra time on the weekend. They drive for Uber or Lyft or DoorDash, whatever the case may be. That 2-year rule still applies, where I ultimately have to show that I've been working on my full-time job for 2 years and that I filed 2 years consecutively of taxes showing as an independent contractor, which is the role of those type of positions. Okay. Now, we did have a question that came in the Q&A around income, which is if you're switching jobs, do you need to be in both for 2 years, or is it just proof of 2 years at the first job and starting at the second job sufficiently? So really, it's not even being on the job 2 years in your current job before you make the switch. It's really just verifying the history of 2 years or educational history. So let's say, for example, I graduated from school. I got my first job. I've been there for 6 months, switched and went to another job, was there for 10 months. Now I have 16 months of job history. And now I'm getting ready to switch jobs. Well, technically, I've only been in the workforce for 16 months, but I do have that educational background to kind of close the gap on the 2-year requirement. All right, hopefully that answered your question. So yeah, essentially you could make that job switch and that wouldn't change anything. But and let me just make sure I clarify this. So for our audience member that asked that too, if just to be clear, if you're starting a second job, like a secondary employment, then if you want to count both sources of income, then it would be simultaneously both 2 years that we have to show for both jobs. But if it's just going to be your second job in your career, then my logic would apply then. All right. Okay, so I want to just quickly talk about expenses versus income. So we're essentially looking at, what does it look like in my current expenses? And then as I take on my housing expense, what is that going to look like as I compare versus my income? We call that debt to income ratio. So when we think about the housing expense, we're looking at the principal and interest of my mortgage. We're looking at property taxes, my homeowner's insurance. If I'm paying mortgage insurance, that gets factored into the calculation, as well as if I bought maybe a condo or a townhouse, I might have HOA expenses. So that gets added in. And then I have all my existing debt. So maybe I have a credit card, maybe I have a car loan, some student loan debt. That all gets baked into the calculation. So as you can see here on our calculation, if we have someone that has a projected house payment of $2,500, they have debts of $500. Right now they have $2,500 or $3,000 expenses, and they're making $8,500 a month. So that tells us in lending that they have 35% of their income, pre-tax income, being allocated towards those expenses. Now, the highest in lending we can get to is 45 to 50% of those expenses being at that level. And the comfort zone, or kind of the sweet spot I would recommend for most clients, is to be around 33 to 36%. So ultimately what that's driving for us is affordability, right? And those are, that's really important to us. We want to make sure that we design affordable and sustainable home buying plans for our clients. And so I would say, a debt to income ratio of about 35% would be a really great comfort level. Now, of course, if we're buying in a high cost of living market, it might be higher than that just due to the nature of the market. We had a question that came in kind of going back to income, which is, does having a few months of unemployment between full-time jobs in the last 2 years negatively impact you? So it doesn't. We just will need to explain, the reason for the unemployment, or we call it sometimes it'd be a job gap. So as long as we can document that and put those dates together, that won't have a negative impact. We saw a lot of obviously, unemployment with the pandemic in 21 and 22, 2020, 2021. And so as long as we can kind of put together those dates, it shouldn't have a negative impact in the qualifying. So, all right, thanks for that question. Last piece of building a plan for most of our clients is to just figure out down payment for home ownership. And as you heard me talk a little earlier this evening, that's one of two challenges that we could have in home buying. Could be around credit or extended debt. or it could be savings for homeownership. So I want to briefly kind of share with you what we generally ask for in validating what resources we have available. Then I want to give you a really simple savings plan in tonight's session. So let's first talk a little bit about documentation. So we always have to verify at least 60 days of assets that are going to be used in a home purchase. So, cash deposits, for example, can't be allowed. We always have to have things paper trailed for the last 60 days. Now, of course, we can do that through checking and savings accounts. Brokerage accounts can be used, 401ks, as long as those are seasoned that 60 days. Even gift funds can be allowed, and that's where a family member is helping contribute to your transaction. So that is absolutely allowed. With gift funds, they're not, they don't have a seasoning requirement. So I could have my uncle that's going to contribute $20,000 to my home purchase, gift those funds right away, and you can see kind of our documentation flow for that, but that is allowed right away. So there's no seasoning requirement for that. Okay. Now, if you're going to access your 401ks or your brokerage accounts, I would encourage you to talk to your investment or your financial advisor. Just want to make sure that we're making the right decision as we access those type of asset platforms. Now, savings is a big part of homeownership. And as we learn about these different products, we have to save up for down payment, probably have to save up for closing costs. And so as I meet with clients in our different educational partnerships, the challenge of savings is real, right? And a lot of us are maybe new in our careers, or we're kind of just trying to figure things out. We got a new job, or trying to pay down student loan debt, whatever the case may be, but we also want to purchase a home. So here's what a simple approach that we always try to implement with our clients is to look at savings in this way. So if you're currently paying, let's say $1,500 a month in rent, but with your current income and as you get your expenses under control, you could afford to, let's say, pay a $3,000 mortgage payment, right? But maybe I'm lacking the savings that I need. What I would encourage a client to do is let's start paying today like we're making that $3,000 mortgage payment. So on May 1st, when I pay that rent payment, I'm not only paying $1,500 to my landlord, but I'm taking $1,500 and I'm paying to my savings account that same amount to get me to the $3,000 number. And it's doing a few things. Obviously, it's all building our savings account. So every first of the month, that $1,500 goes into my savings account. End of 6 months, I got $9,000 in growth in my savings account. End of 12 months, I have $18,000. And that grows, not including high yield accounts and interest. And so that is a huge opportunity, and that can make homeownership that much more of a closer goal. But it also creates the rhythm or the discipline of saving and getting into the habit of making that $3,000 mortgage payment. So it's really not as big of a payment shock for you when you start to take on a mortgage payment. Okay, so that's kind of a look at savings. And there are first-time buyer programs that can help make that gap much less for you in savings. And so we want to talk really briefly about some of the Florida-based HFA programs. And I would encourage you to get connected with me after tonight's session if you want to see how some of these first-time buyer programs can really help support you on that path towards homeownership. The first program is the Florida Assist program that can provide up to $10,000 in assistance. It is a deferred payment on that program. So essentially, you don't have to pay back the assistance until you either sell or refinance the home. There's also the Florida Homeownership Loan Program, which provides up to $10,000 in assistance, but it's forgivable after a 15-year term period. So there'll be some requirements on, staying in and occupying the home as your primary residence over the course of those 15 years. There's also a 3%, 4%, and 5% preferred and HFA Advantage program that essentially provides forgivable assistance programs. Now, as you elect one of those different levels of resources, interest rates can change on those programs. And that's why I would encourage you to kind of sit down with us to kind of figure out which is the right product match for you. So depending on what level of resource you need, of course, we would have an adjusted payment or adjusted interest rate that would correspond to how much in resources you take. And then in Florida, there's the Hometown Heroes housing program. So you can get special incentives if you're a first responder, you're in education, you're a healthcare professional, childcare employee. So you can see kind of the list goes on there. So there's a lot of great resources for you. So, I think for our prospective buyers to believe that you have to have 20% saved up, or, you only can do an FHA loan with 3.5% down is really not the case. There's a lot of fantastic resources out there to you as a first-time buyer. Now, nationally, we do have the Pathway DPA program. It's an APM program. It's only good for the FHA product, but it does provide 3.5% to 5% of your loan amount in assistance that, again, can support you on this journey towards homeownership. All right. So that's a quick look at some of the first-time buyer programs. And again, I'd love to be able to kind of share with you more about some of those details and see which programs could be applicable to you. Now, each of those first-time buyer programs does have income limits that we can share with you after tonight's session. Last topic for tonight's conversation is to take a look at the home buying process. And, as we leave tonight's class, and you're thinking about pursuing home ownership, I think it's really helpful to understand the milestones that you're going to experience as a potential buyer. Now, as you leave tonight's class, we're going to give you kind of our next steps or our get started information if you want to get connected with us for a free consultation, which is a no obligation opportunity. But ultimately, as we meet with clients across the country, we're going to design home buying plans for them. And then the output of that session we have with them is to issue what we call as a pre-approval, which essentially gives them their buying power to go out and start looking at homes. Now, a pre-approval is good for 60 days, but it can be always recertified at any time. So the online application that you do with our team stays active for 2 years, so you don't have to worry about or feeling pressure to go out and buy right away. We ultimately want to just kind of provide the framework for you with home buying. So a pre-approval gets presented to a seller when you identify a property that you want to make an offer on. Now, that first comes with the house hunting phase, which generally starts online, where you're going to get on Zillow or Redfin and kind of identify communities and particular properties that you like. And we would encourage you to get connected with a local realtor in your community that should be an expert on what characteristics in the community you're looking for, expert in negotiations, really has an influence in their market to provide you with the right home buying options. And we do have a preferred realtor network, so we can always get you connected if that need ever arises. But generally, the house search will go from usually online to in person, especially as you identify a few properties that fit all the criteria that you're looking for. Now, if you zero in on that one house that you want to make an offer on, that realtor is going to help construct that offer for you and ultimately present it to the selling agent on that property. Now, if it happens and your offer gets accepted, now you move to step 3, which is called the entering escrow phase. So now that means you have a ratified contract with a seller. In most parts of the country, from day 1 of the acceptance to day 30 usually is when you get your keys. So the process is usually 30 days, but it can be a little bit shorter depending on how you've negotiated the contract. And within that contract, there's various timeline obligations that we have to meet. And we'll talk more about that in just a minute. But usually on the day that you have the accepted offer, you're going to get a call from me saying, congratulations, you got your offer accepted, which quite honestly, it's probably one of the bigger heavy lifting items for our buyers in the process. It's just finding the right property, right? Now, obviously, we have some really great inventory levels in Florida, so hopefully it won't take as much. But ultimately, when that offer gets accepted, we're going to call you, say congratulations, and then we're going to walk you through next steps, which includes getting connected with us for another video consultation to figure out, like, what's the market look like now for interest rates? What's my payment going to look like on this house? How much is my out-of-pocket going to look like? Make sure we have complete clarity for you as you now start into the next milestones. Now, those milestones include a kind of a contribution from you into the transaction, which is called an earnest money deposit. That's usually part of your purchase agreement. In most parts of the country, it's going to require you to make a deposit of 1% to 2% of the purchase price. Now, that deposit will count towards your total out-of-pocket, but it is ultimately kind of a good faith deposit that basically tells the seller that you have a financial stake in the success of this transaction. Now, within the contract, there are contingency periods that allow you to do your kind of homework on the property. Most contingencies will include an appraisal contingency to ensure the home is worth what you're buying it for, a loan contingency to ensure that your financing gets put in place properly, and of course, getting your inspections done to make sure the house is in the working order that you expect, right? In most parts of the country, that contingency period can be anywhere from 10 to 21 days within the contract period. And it will ultimately kind of protect your deposit. So if things kind of go awry with some of those inspections, you have that protection to be able to potentially get out of the contract if things just don't feel right for you as a buyer. Now, as we continue down these milestones, step 4 is more of the administrative functions of the transaction, like verifying your employment, verifying your assets, making sure maybe your first-time buyer program is set up properly. Ultimately getting everything prepared to go to the underwriting team. Now, we talked a little bit about interest rates tonight, and interest rates vary over the course of the trading day. Now, once you're under contract with the seller, then we're kind of strategically looking at the market to hopefully time the market for our lowest rate opportunities. So there's some strategy to that, because as you learned earlier, rates can change by the minute. And so we want to make sure we seize the right opportunity for our clients. And we can do that certainly once you go under contract with the seller. Step 5 is your loan approval. That's where the underwriter has verified your assets, your income, done all the kind of the checkpoints that are required as part of the underwriting guidelines, and issues that loan approval. Our team will work with you on some of those approval items. Now, throughout the process, you're going to be receiving e-signature disclosures, which include initial disclosures, which is within 72 hours of your contract. You also get revised disclosures once your interest rate is locked. And then finally, once we get to step 5 in the process, you get a final closing disclosure, which ultimately creates a 3-day cooling off period before we get to step 6 in the buying process. Now, that step 5 will also bring you to the end of your contingency period. So if everything kind of checks off for you with your inspections, your approval, and your appraisal, then you'll be able to remove your contingencies in the transaction. And as we do that, now that transitions us into the very final milestone, which is the home loan closing. Now, that is the date of closing when you're going to be signing final loan documents with the public notary. Those documents get all sorted out. It takes about an hour for that process. At the same time as your lender, we fund the loan to the escrow team. And those funds ultimately stay there with the escrow company until they're ready to record documents with the local county recorder's office. They record what we call as a grant deed that transfers ownership to you, as well as the deed for the loan. That is ultimately the repayment terms of the loan. And after that all gets officially recorded, then we get to make our favorite call of the day. I did a few of those this morning, which is to say, hey, congratulations, you're now the new homeowner. And that's a really exciting time. It's a huge celebration, huge accomplishment, right? Because, you know, you've successfully really achieved the American dream of homeownership. And it starts a lot with these classes and then ultimately goes to pre-approval and finding a home and getting the keys. But it's a really cool opportunity for those that choose to go down that path. Now, our relationship with our clients doesn't end at the closing, because we have an aftercare program that ultimately will help you seize the opportunity when it makes sense to maybe refinance your home or maybe look at your home equity position. And so we're going to make sure that we provide you with all the monitoring tools you need for that. And we certainly check in with our clients on an annual basis, because let's face it, things change for our clients financially all the time, right? And we want to be there as a support for you as those changes happen and help provide you with the right education. Now, if you're thinking about moving forward in homeownership and want to take that path towards homeownership, we have a very simple non-obligation get started process, which ultimately allows you to do an online application. We only do a soft credit check, as you heard me mention earlier. Then you would upload documents and then use our scheduling system to schedule the consultation for you, which is ultimately a 30-minute session that I do with you one-on-one on video to talk about different ideas for you around homeownership. Now, after tonight's session, you may have a few questions about maybe credit or your financial situation. We'd love for you to get connected with us by scheduling an introductory call. You can also do that through our scheduling system. You can find all the links noted here. All right. As we wrap up, I just want to kind of give you kind of the bullet points, if you will, on our consultation service. So it's talking about where do I want to buy? What's my budget look like? Let's talk about credit opportunities, first-time buyer programs. Just a really comprehensive deep dive into homeownership for you. And again, this isn't something that we have to be ready to go buy this year. We just want to provide you the framework, goals, and objectives for homeownership. So it could be something that we're looking at maybe even next year, right? Now, as we wrap up, just want to point out one of our resources. You know, we really embrace technology too in our process. So we have our mobile tools available. You can start the application process right there. You can use some of the calculators within our APM mobile tool. Also, it will send you push notifications as we go through the buying process. I pointed out our discount again. I just want to make sure that you're aware in partnering with us for either a home purchase or a refinance at some point. We do provide a credit of $750 towards your closing costs. And our services are a no obligation opportunity for you. We just want to be a partner with you on this journey towards homeownership. So, you know, we'll have future classes like this. I believe we have 2 or 3 more classes this year that you can always attend if you want to do a refresh. But we'd also encourage you to share some of the content with friends, family, and coworkers that also might enjoy some of this material. And we also have other partnerships across the country. So, you know, we really believe in supporting our local communities in homebuyer education. And so we do that through other partnerships that you can see here on screen. Well, that brings me to the end of class, and I wanted to pass along my contact information. You can see here all of my numbers. We also have our social here. You can find us at JMeda Mortgage. The video for tonight's class that's being recorded right now will be up on our YouTube channel tomorrow. We did have a question in the Q&A, which is the deck being shared? And it will. So those that signed up for our class tonight will also get the presentation material. So you'll get that out tomorrow morning. We really hopefully get a chance to connect with you. We do appreciate the time that you've allocated to us tonight to listen to our class. We do hope we get a chance to connect with you and build your own home buying plan and help you on that path towards home ownership. I'm going to stick around a little bit. I know we're right at the top of the hour. I'm proud of ourselves. We got to the very top, and you guys had a lot of great questions so far in the class, but I'm going to stick around for a few more minutes. If you do have questions, you can drop those in the Q&A or the chat section. And of course, we can always get connected with you offline if you have a specific question for financially that you want us to address as well too. So I'll go ahead and hang tight for a little bit longer. Appreciate the thanks in the chat. That's awesome. I appreciate you attending. I'm going to scroll through the Q&A so make sure I didn't miss anything. I know Ken was taking on a few questions. You're welcome. Cool. Awesome. Okay. Okay. Good question that popped in, which is, are the first-time homebuyer programs applications that are separate from the loan applications? So for most programs, it is not separate. So when you apply with APM, because we're an approved lender for these programs, we will basically orchestrate the registration for the programs. The only thing that you would be doing outside of our application platform is you would have to do homebuyer education. So each program has specific education that we can kind of talk a little bit more offline. But yeah, so as you apply with us, we'll take care of kind of the internal admin work on those. Thank you for that. Okay, you're welcome. Cool. All right. I appreciate everybody sticking around. We had a great attendance tonight. Again, we'll have this class up on our YouTube channel tomorrow. Hope I get a chance to get connected with you guys to build your plan towards home ownership. Thank you so much for attending tonight's class, and we'll see you soon. Good night.